Nick, good to see you. We are diving into the headlines today and we are going to talk through recession-proof investing, 4 tips for navigating this market volatility. Of course, we've all been seeing the headlines lately and it is stressful and scary right now. We're seeing what we're seeing in the markets. What's going on?
Well, and I'm glad we're talking about this because there's a lot of news, and it's almost like every bit of news is almost negative.
Mm,
Um, and so there's a lot going on right now and people are rightfully so. They're getting really concerned with everything. They're starting to see real estate not being what it was before. Now houses are on the market for almost 2 months. That was unusual. That it has been unusual. They thought interest rates were going to drop, and now the Fed comes out a couple weeks ago and says, "Oh, we're going to keep interest rates. Probably not going to cut those until the end of 2025. So we're not going to drop them like we thought we were going to." And what happens at that day? I think the stock market was down 600 or 700 points that day. The stock market doesn't like that,
no.
and the reason being is when interest rates stay higher for these longer periods of time, you have people that can't get good mortgages to get houses. And we're seeing mortgage rates at highs, like all-time highs right now, back again. It should have been down by now, but that's not happening. And then we see loans that companies can get to keep their companies going. They're not able to get loans because interest rates are too high. And so now those companies are starting to lay people off. And then you just go in Google and just type in layoffs, and you'll start seeing all this company laid off 1,000 people, this company laid off 1,000 people. So we're seeing all that now starting to happen. And we're starting to see the stock market momentum slow down. Now the stock market's still at all-time highs, but we're starting to see the momentum slow down. It's almost like, if I stop a cruise ship cold, it's still going to coast for a little bit before it comes to an all-time stop. We won't see it for a while, and we're starting to maybe see that in the stock market. And this didn't just happen. It's been in the works for a long period of time, especially when the Fed started cutting rates is when this all started happening. And so what we always tell people is, irregardless of this, for the reasons of whatever is causing whatever, it doesn't matter. When you build a financial plan, you have to have 2 rules in place. First is the rule of 100, or the rule of 1. Every 1 year, there is going to be a market correction. Now, market correction is anywhere from a 10 to a 20% drop in the market. That is going to happen usually every 1 year. And the last time it happened was over 24 months ago. So we're been due for one. And then the second rule is what's called the rule of 5. Every 5 years, there's a market crash. That's a crash of over 20%. Well, the last time that happened is going back to 2022. So again, we're getting close to when that might happen too. So I don't want people to think this never happens. No, the market, just like a runner
Right.
or a sprinter is going to need to take a break, right? They can't just keep sprinting. Stock market, same way. And so we're starting to see this slowdown happening, and we don't know what kind of slowdown that's going to be, if it's going to be a big one or a small one. Either way, you just got to be sure that your portfolio and the way you have your finances structured can sustain whatever that is.
Right. So now let's get into some possible strategies for investing during a recession or a market downturn. A lot of people wonder, is cash king? Are you advising clients to allocate more of their portfolio to cash right now?
Well, the thing is, you should always have money that's balanced between what we call green money and red money. Green money being protected money, and sometimes that's emergency money or money that's not affected by a stock market drop. And then red money, which is your risk money that does get affected when the market fluctuates. The problem is when the market goes up, people get out of balance. The market goes up and then they want to get out of all the green money and put all their green money into red money. So as the market keeps reaching and going up to these tops, people feel like they're missing out. It's FOMO, fear of missing out. So they take all their safe money and they take it out of here and they put it over here. They buy in at tops. And that's the worst thing that you can do. So what you almost need to do is come up with a plan and then just stick with that plan. So you should always have emergency money, cash stash money, because the last thing you want to do is, if the market does go down, sell it shares of stock at losses to be able
Mhm.
to cough up money to be able to spend. You don't want to sell at losses to be able to do that. So you should
Mhm.
always, always, always have emergency cash stash money. principal protected money, and risk money, and figure out what your percentages are and then stick with that. Don't deviate from it because the market's going up or whatever.
Mhm. How about defensive stocks like healthcare, utilities, consumer staples like food and beverages? These are fairly recession proof since people still get sick and we still need to eat.
It's not bad, but it's not risk free. And so consumer staples, utilities, all those are still going to fluctuate, even if the market is heading down, or even if we are in a recession, just less so. How I look at that is, well, if the stock market's down 10 and these are down 5, it's still down 5. It just didn't lose as much. So I guess you could say it's outperforming, but it still doesn't do any good for you if you're still going down. So I really like alternatives or principal protected investments to really help out. I really look at things as there's almost 3 levels of diversification. And one level of diversification is what I call stock diversification. That's entry level diversification. That's where, again, you might have all these different types of stocks like healthcare and utilities, and then you have other equities, and you have a bunch of these that move in different ways, and that's like stock diversification. But then the next level up in diversification, we'll call that level 2, would be like alternative strategies that maybe you can't lose money unless a certain threshold is broken. And then maybe the third level of asset allocation or diversification is principal protection. This money is never going to be affected at all. It can still grow, but this money can never be affected at all if the market takes a nosedive. So you almost need to have these 3 levels of diversification in place, not just one. And so it goes beyond the healthcare, to utilities, and the consumer staples, because those are still not risk-free.
So, what do you think then about dividend stocks and fixed income investments like bonds?
Well, so kind of in the same vein, I'll touch on bonds real quick. That's a good one. So bonds, if we look at just the TLT, you can look that up, ticker symbol. If you have a smartphone, look that one up, TLT. And if you just look at what that did from 2021 to right now in 2025, that's down 40%. That's the 20-year Treasury bond. And so that's susceptible to interest rate risk. So it's not risk-free. Dividend stocks are also not risk-free either. It's just the nice thing about dividend stocks is it pays a dividend. So if the market goes down, you're still getting a dividend for owning the stock. So you don't feel like you have to sell out of it, because at least you're getting a dividend for continuing to hold it. But what I like better than those is something called structured notes. What I like about structured notes is they can still provide dividend-like income, interest income, and sometimes better than the dividends from stocks. But what happens is the risk in it is you're usually insulated unless the market goes down more than 30%, like a buffer, so to speak. So if the market goes down 10%, no big deal. 20%, no big deal. But if the market goes down more than 30%, then you do have risk to your principal. But that's a pretty big drop. And so the nice thing about that is if the markets go sideways and you have strategies like this in place, and you're getting maybe a 6 or 7 or an 8% interest on your money, that can be nice, because you're getting that interest on your money while the market's going nowhere. And then you have this big buffer to the downside that is almost like a protective nature, to where only if the market goes down this far do you have risk to your principal. And so there's some things that you have to look at that's out there. There's obviously you always want to look at the pros and the cons and the strings attached of everything. But there's different. I just don't want people to think, oh, it's only dividend stocks, because I remember Mom talking about that in the 80s, and that must be it. No, there's so many other things out there that people can tap into now.
Right, right. Last, even during downturns, or especially during downturns, keep investing. This is known as dollar cost averaging.
If you're 20, 30, 40, 50,
Yeah.
and you're still working, and the market goes down, you're buying stock at a discount.
Right.
So you keep going, but it works in reverse when you retire. Because when you retire, and let's say you're now 70 years old, we call it reverse dollar cost averaging. Because you're not saving money, you're now spending money. So if the market goes down, it's not that you're investing more money in and buying at lower prices. You're now selling stock at lower prices. And so that can be the quickest way to running out of money during retirement is when the market is going down and then you're selling out of stuff to be able to pay for what you need to pay for. And so the market's down 10, but then you're withdrawing 5%. Now you're down 15%. So you just want to make sure with your portfolio that you don't have too much volatility when it comes to retirement. You cannot invest at 65, 70, 75 when you're pulling money out. You cannot invest like you did when you were 20, 30, and 40 and 50, just because of the volatility and how that affects things when you start to use your money for income in retirement.
Right. And this all comes back to what you say all the time, Nick. It comes down to having a financial plan that you can stick with during these volatile moments so that you don't react emotionally to the headlines. And you have some tips to share with everybody.
Yeah, well, I mean, number one, I'm going to go to the end because, we usually read left to right. I'm going to go right to left. So
all right, let's do it.
Right, you stay the course, but you can only stay the course if you actually have a plan to stay the course with. Because that's the one thing that's missing here is you got to have that plan that you can stay the course with. If you think about a flight plan for an airplane, they have the flight plan and then they just stay the course. And sometimes they need to deviate and tweak it, but that's what helps them avoid the panic because they have this flight plan that they can do. But you don't take off in an airplane unless you have a flight plan. So you got to get that flight plan first. And then that allows you to stay calm because you have this plan in place.
Right.
And you don't want to try and time the market because the markets are volatile. They go up, they go down. What you do is you create a plan that's durable and can withstand both good and sour markets. That way, when the markets are sour, all you have to do is stay with the plan. You can keep calm. You can avoid panic selling because you've got the right balance between green money and red money. And when the market goes down, you don't use the red money. You can go to the green money and you can use that to get by while you're waiting for the red money to bounce back. And then that allows you to have this situation where you can just stay calm and not be reactionary, emotional, and making the wrong decisions at really the wrong time. And so it's having that plan, having that right diversification, having the right, in those levels that we talked about, 1, 2, 3, having the right diversification, having alternative strategies in place, principal protection, all that wrapped together. But a lot of people don't have the plan in place, and don't be scared about it. It's not a frightening thing. It's something that you just got to have done.
Absolutely. And the sooner the better so that we are not, feeling stressed out by these scary headlines that we see.
Especially right now. I don't look at this, because the markets are still at all-time highs, and I think people get comfortable and they say, you know what, nothing really bad has happened yet, so now I'm not going to really do anything. Now is the time to do it. You don't want to wait for the market to go down and then, now I'll plan.
Right.
No. You do it when the markets are where they are now so that when that happens, which it will, you actually are like, hey, I've already got the plan in place. I don't have to worry about it because it's, it's done and it's ready to go. So, every great strategist, if you go back in time to military, every great strategist, every great general had the plan for what was the worst case scenario in advance. They weren't like, this happened. Now what do we do? They already knew. And so the same thing is, you don't go, just like a great general doesn't go into a battle without a plan. Retirement is almost like that battle. It's a 20 to 30 to 35 years. Retirement is like a 20 to 30 year battle against taxes, against healthcare issues, against stock market crashes. And you got to have that plan in place so that you can get through all that.
Well said, Nick. And the sooner the better. So if somebody would like to contact you to create their own unique personalized retirement plan, what's the best way to reach you?
The easiest way is they can schedule a 15-minute strategy session with us. Go to group10financial.com. And we have our online calendar right there. And one of the team, you can schedule a time with one of the team for just a quick 15-minute strategy session call where we can really see if you're on track, what's going on, answer your questions, and see how you feel about where you're at right now and see what can be done to help you feel better about what your prospects are going forward. Ultimately, Retirement should be where you feel really good about where you're at,
Yeah.
and you never
Right.
feel bad when you turn on the news and you hear all this stuff going on and you start freaking out. It would be nice if you could turn on the TV and you could say, I know this is going on, but I got a plan and I'm fine.
Yeah. Well said. Peace of
That's
mind. Nick, thank you so much.
very good.